What if I told you that the single greatest book on investing was written over 70 years ago, before the internet, before meme stocks, cryptocurrencies, and 24/7 financial news, before algorithms traded stocks in microseconds, a time when you had to call a broker on a landline phone just to make a trade? It sounds impossible, right? How could wisdom from a bygone era possibly guide us through frenetic, digital chaos of today's markets? How could a man who never saw a smartphone teach you more about looking into the hype around Tesla, the FOMO of Dogecoin, or the promise of the FIRE movement than any influencer on social media? The answer is simple. Because while the tools of the market have changed, the single most important factor is not: human nature. Fear, greed, panic, and euphoria, these are the forces that have always driven markets, and they're the forces that Benjamin Graham, the father of value investing, taught us how to master. Welcome to Captura. Today, we are not just reviewing a book. We are absorbing philosophy. We are taking a deep audiobook-style look into the definitive guide to long-term wealth creation, The Intelligent Investor by Benjamin Graham. This isn't just a summary. It's a translation of timeless wisdom for the modern world. Stay with us, because the principles in this book are the bedrock upon which fortunes have been built, and they are the shield that will protect you from the financial madness of our time. The author and the book's genesis. Benjamin Graham wasn't just an author. He was a legendary investor, a brilliant academic, and the mentor to one of the most successful investors in history, Warren Buffett. When Buffett was a young student at Columbia University, it was Graham who shaped his entire investment philosophy. In fact, Buffett has said that The Intelligent Investor is by far the best book on investing ever written. That's not a casual compliment. It's a testament to the book's profound and enduring power. First published in 1949, this book emerged from the ashes of the Great Depression and the Second World War. Graham had lived through the Roaring '20s, a period of wild speculation, not unlike the tech and crypto bubbles we see today. He then witnessed the devastating crash of 1929, where fortunes were wiped out overnight. He saw firsthand how emotional decision-making, herd mentality, and baseless speculation could lead to financial ruin. This experience forged his core philosophy, a defensive and disciplined approach designed not just to make money, but more importantly, to avoid catastrophic loss. Why the wisdom still matters: modern market chaos. So, why does a book written in the age of black and white television still command such respect? Because Graham doesn't offer hot stock tips or secrets to timing the market. He knew that was a fool's errand. Instead, he provides something far more valuable: a framework for thinking. He teaches you how to develop the right temperament, the right discipline, and the right analytical process to become a successful investor for life. Think about the modern investing landscape. You open an app like Robinhood, and you're hit with a confetti animation for making a trade. You scroll through Twitter or Reddit's Wall Street bets and see stories of people turning a few $1,000s into millions on a meme stock like GameStop or AMC. This is a world of FOMO, the fear of missing out. It preys on our most basic instincts. It encourages us to gamble, not to invest. Graham had a name for this. He called it speculation, and he drew a crystal clear line in the sand between the speculator and the investor. The speculator bets on price movements. The investor, on the other hand, analyzes the underlying business. This distinction is more critical now than ever. When you see the price of a cryptocurrency like Dogecoin, which was started as a joke, skyrocket based on a celebrity's tweet, are you looking at a valuable asset or a speculative frenzy? Graham's principles would force you to ask, what is the underlying value here? What is my margin of safety? The same goes for the hype around revolutionary companies. Think of Tesla. Its supporters see a visionary leader in a world-changing company, justify a valuation that towers over every other automaker combined. A Graham-inspired investor, however, would calmly push the story aside and look at the numbers. They'd analyze the earnings, the debt, the competition, and the price they're being asked to pay for a piece of that business. They would separate the story from the substance. Even for those of us pursuing a more stable path, like the FIRE movement, financial independence, retire early, Graham's wisdom is indispensable. FIRE is built on high savings rates and consistent long-term investing, often in low-cost ETFs, exchange retirement funds. This is the modern embodiment of Graham's defensive investor. It's about disciplined patience and letting compound interest work its magic. All core tenets of his philosophy. Graham provides the intellectual foundation for why the strategy works and how to stick with it when markets get scary. The intelligent investor is not a rule book. It's a mindset. It's the voice of reason that whispers in your ear when the crowd is screaming buy. It's the anchor that keeps you steady when the market storms are raging. It teaches you that success in investing doesn't come from a high IQ or insider information. It comes from having a sound intellectual framework and emotional discipline to keep from sabotaging yourself. In the chapters that follow, we will break down Graham's most powerful ideas, one by one. We will explore the crucial difference between investing and speculating, meet the manic-depressive Mr. Market, master the concept of the margin of safety, and learn how to build a portfolio that lets you sleep at night. And after every chapter, we'll connect that timeless wisdom to the challenges and opportunities you face right now in the 21st century. This is more than a book summary. This is an operating system for intelligent investing. Let's begin. Chapter 1. Investment versus speculation. Results to be expected by the intelligent investor. Graham kicks off his masterwork by drawing the most important line in all of finance, the one separating investment from speculation. This isn't just semantics. It's the foundation of your entire financial life. For Graham, the definition is precise and non-negotiable. He states, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Let's look into that. It has 3 essential parts. Thorough analysis. This means doing your homework. You must study the business behind the stock. You need to understand its financial health, its management, its competitive position, and its long-term prospects. It's not about reading a tweet or seeing a stock mentioned on the news. It's about objective, rational research. Safety of principal. This is Graham's prime directive. Before you even think about the potential return, you must focus on not losing the money you started with. This doesn't mean there's zero risk, but that the risk of permanent loss is minimized through your analysis. An adequate return. Notice he doesn't say a spectacular or market-beating return. Adequate is a humble, realistic word. It means a reasonable, satisfactory profit, not a lottery ticket jackpot. If your reason for buying a stock fails any of these 3 tests, you are not investing. You are speculating. The speculator buys a stock because they think the price will go up. Their focus is on the market's mood, the chart patterns, the buzz. The investor buys a stock because they believe the underlying business is worth more than the price they are paying. Their focus is on the business's value. The speculator is playing the player. The investor is playing the game. Graham is not judgmental about speculation. He acknowledges that it's a part of the market and can be an exciting, if dangerous, activity. But he insists that you must be brutally honest with yourself about which game you are playing. He suggests that if you must speculate, you should keep it in a separate account, with a strictly limited amount of money you can afford to lose entirely. Never, ever mix your speculative money with your investment money. This separation is crucial for emotional discipline. He then outlines the 2 types of investors we'll meet throughout the book, the defensive investor and the enterprising investor. The defensive investor seeks, above all, freedom from effort, annoyance, and the need for constant decision-making. Their goal is safety and simplicity. They might build a portfolio of high-quality bonds and a diversified basket of leading stocks, or, in today's world, low-cost index funds. The enterprising or aggressive investor is willing to devote significant time and effort to research and analysis in the hopes of earning a better-than-average return. This doesn't mean taking on more risk. It means doing more work to find undervalued opportunities. Graham makes it clear that being an enterprising investor is not for everyone. It requires skill, dedication, and the right temperament. For most people, the defensive path is a wiser choice. Modern takeaway. Think about the rise of commission-free trading apps like Robinhood. They have made it incredibly easy to buy and sell stocks, often framing it as a fun, game-like activity. This environment blurs the line between investing and speculating more than ever before. When you buy a slice of a meme stock because a Reddit forum is buzzing about a short squeeze, you are speculating. There is no thorough analysis of the underlying business's health or long-term prospects. You are simply betting that someone else will buy it from you at a higher price later. Graham would look at the crypto world and apply the same logic. Is buying Bitcoin an investment or speculation? A true Graham-style investor would struggle. They would ask, what is the intrinsic value of Bitcoin? What cash flows does it produce? How can I analyze it like a business? Since these questions are difficult, if not impossible, to answer in traditional terms, Graham would almost certainly classify most crypto purchases as pure speculation. This first chapter is a wake-up call. It forces you to look in the mirror and ask, am I an investor or am I a speculator who just calls investing? Honesty here is the first step toward financial sanity. Chapter 2, The Investor and Inflation. In this chapter, Graham tackles a silent wealth killer, inflation. Inflation is a rate at which the general level of prices for goods and services is rising and subsequently, purchasing power is falling. $1 today is worth more than $1 tomorrow. If your investments aren't growing faster than the rate of inflation, you are actually losing money in real terms. Graham lived through periods of both high inflation and deflation, so he understood its dangers intimately. He points out that investors have historically relied on two main asset classes to protect themselves: stocks and bonds. Bonds are traditionally seen as safe. You lend money to a government or a corporation, and they promise to pay you back with interest over a set period. The problem, Graham notes, is that this interest rate is fixed. If inflation suddenly spikes to 8% and your bond is only paying you 3%, you're losing 5% of your purchasing power every single year. Your safe investment is a guaranteed loser in real terms. Stocks, on the other hand, offer a better, though not perfect, hedge against inflation. Why? Because a stock represents ownership in a real business. When prices rise across the economy, a good business can often raise its own prices, increasing its nominal earnings. This, in turn, can lead to higher dividends and a higher stock price over the long run, helping your investment keep pace with or even outrun inflation. Graham suggests a balanced approach. He advocates for the defensive investor to consider a portfolio split between high-quality bonds and a diversified group of common stocks. He mentions a 50-50 split as a reasonable starting point, to be adjusted based on market conditions and personal risk tolerance. He also explores other potential inflation hedges, such as real estate and commodities like gold. He is somewhat skeptical of gold, noting that its price is highly speculative and it produces no income. Real estate, he argues, can be a good investment, but it requires significant expertise and is not a passive endeavor. The core message of this chapter is that investors cannot afford to ignore the long-term corrosive effect of inflation. Simply holding cash or low-yielding bonds is not a viable long-term strategy. You must have a portion of your portfolio in assets, like stocks, that have the potential for real growth. Modern takeaway. Graham's warnings about inflation have never been more relevant. In the post-2020 era, the world has experienced a significant surge in inflation, reminding everyone that it isn't just a relic of the 1970s. Today, investors have more tools to combat inflation than Graham did. For example, the U.S. Treasury offers TIPS, Treasury Inflation-Protected Securities. These are bonds whose principal value adjusts upward with inflation, providing a direct and guaranteed real return. Graham would have likely seen these as an excellent tool for the defensive investor. His analysis of stocks as an inflation hedge remains spot on. Companies with strong pricing power, think of giants like Apple or Coca-Cola, can pass on rising costs to consumers, protecting their profit margins. This is why a portfolio of high-quality, market-leading businesses is such a powerful long-term wealth builder. What we think of cryptocurrency as an inflation hedge, many proponents of Bitcoin call it digital gold. Arguing its limited supply makes it the ultimate protection against currency debasement. Graham, ever the pragmatist, would be highly skeptical. He would point to its extreme volatility, its lack of income generation, and the speculative nature of its valuation. He would argue that its price is driven by sentiment, not by any underlying business value. While it might act as an inflation hedge, its speculative nature would violate his core principle of safety of principle. He would likely categorize it once again as a speculation, not an investment. This chapter reminds us that our investment strategy must always account for the silent thief of inflation. Chapter 3. A Century of Stock Market History. In this short but powerful chapter, Graham takes the reader on a tour of stock market history up to this time. His goal is to provide perspective and to demonstrate a crucial point. The future will never look exactly like the past, but the patterns of human behavior repeat. He presents data showing the long-term upward trend of the stock market, punctuated by periods of wild bull markets and devastating bear markets. He highlights the relationship between stock prices, earnings, and dividends over many decades. His primary finding is that while stock prices can be incredibly volatile in the short term, they are ultimately tethered to the underlying performance of the businesses they represent. In the long run, earnings growth drives stock returns. One of the key concepts he introduces here is the idea of forecasting. He is deeply skeptical of anyone who claims to be able to predict the market's next move. Looking at the historical data, he shows that the experts have been consistently wrong. They are often most bullish at market tops and most bearish at market bottoms. Therefore, the intelligent investor should not base their strategy on predicting the future. Instead, they should base it on preparing for multiple possible futures. This is done by focusing on price and value. The investor's job is not to forecast the growth of an industry, but to determine a reasonable price to pay for a piece of that industry today. He uses the example of growth industries like air transport and electronics in his day. Everyone knew they were going to grow spectacularly, but buying stocks in those industries at any price was a recipe for disaster. Many of the early companies went bankrupt, and investors who overpaid for the eventual winners often saw poor returns for many years. The lesson is that even if you are right about the future of an industry, you can still lose a lot of money if you pay too high a price for your shares. The main takeaway from this historical review is a call for humility. The market is a complex system, and no one can predict its short-term movements. The intelligent investor accepts this uncertainty and instead relies on a disciplined strategy of buying good businesses at sensible prices. Modern takeaway. Let's apply Graham's historical lens to the last few decades. Imagine what he would say about the dot-com bubble of the late 1990s. It was a perfect echo of the manias he had studied. Investors were convinced that the new economy of the internet had changed the rules of valuation. Companies with no profits and sometimes no revenue were given multi-billion-dollar valuations based on eyeballs or clicks. The story was compelling, but the prices were insane. When the bubble burst in 2000, trillions of dollars in speculative value evaporated. Graham would have seen it coming a mile away, not because he was a psychic, but because he recognized the historical pattern of speculative excess. Now, consider the rise of FANG stocks, Facebook/Meta, Amazon, Apple, Netflix, Google/Alphabet. These companies have generated incredible returns and have come to dominate the market. An investor in the early 2010s who bought and held them would have done spectacularly well. Does this invalidate Graham's warnings about growth stocks? Not at all. A Graham-style investor would have analyzed each of these companies based on their individual merits. In the early days, some of them, like Apple or Google, were trading at very reasonable prices relative to their massive and growing earnings. Buying them then would have been a sound investment based on thorough analysis. However, at other times, their valuations have become stretched and speculative. The intelligent investor's job is to differentiate between the periods of rational pricing and the periods of speculative hype, even for the best companies in the world. This chapter teaches us that studying market history isn't about finding patterns to predict the future. It's about understanding the range of human emotions and market valuations so that we are not surprised when the next bubble or the next crash inevitably arrives. It builds the emotional resilience needed to be a long-term investor. Chapter 4. General Portfolio Policy. The Defensive Investor. Here, Graham lays out a practical, step-by-step guide for the defensive investor. Remember, this is the investor who wants safety plus freedom from bother. The goal is not to shoot the lights out, but to build wealth steadily and securely without becoming a full-time stock analyst. The cornerstone of the defensive investor's policy is asset allocation, the mix between stocks and bonds. Graham proposes a simple starting point, a 50-50 split. 50% of the portfolio in high-grade bonds and 50% in a diversified portfolio of common stocks. He stresses that this is not a rigid rule. The investor should be prepared to adjust this allocation based on market levels. However, he warns against making large, frequent changes. He suggests a mechanical rebalancing strategy. For example, you could set a rule to never have less than 25% or more than 75% in stocks. When the market has a huge run-up and your stocks now represent 65% of your portfolio, you would sell some stocks and buy bonds to get back closer to your 50-50 target. Conversely, after a market crash, when your stocks are down to 35%, you would sell some bonds and buy stocks. This acts as an automatic discipline. It forces you to sell high and buy low, the exact opposite of what our emotions tell us to do. It's a simple but brilliant mechanism for controlling risk and taking advantage of market volatility without needing to predict it. Next, he addresses a question of which specific bonds and stocks to buy. For bonds, the answer is simple: safety first. He recommends high-quality corporate bonds and, even better, U.S. savings bonds or other government securities. The goal is not to get the highest possible yield, but to have a stable anchor for portfolio that will preserve capital. For stocks, he provides for simple rules for the defensive investor: adequate diversification. Don't put all your eggs in one basket. Graham suggests owning between 10 and 30 different stocks. This spreads your risk so that a disaster at one company doesn't sink your entire portfolio. Large, prominent, and conservatively financed companies. The defensive investor should stick to well-established industry leaders. These are companies with a long history of profitability and a strong balance sheet. Think of the blue-chip giants of the economy, a long record of continuous dividend payments. Graham puts great emphasis on dividends. A consistent history of paying dividends, he suggests 20 years, is a strong indicator of a company's financial health and stability. It shows that the company has weathered multiple economic cycles and has a shareholder-friendly management, a limit on the price to be paid. This is the value component. Even the best company can be a bad investment if you overpay for it. He suggests a limit on the price-to-earnings, P/E, ratio you should be willing to pay, perhaps no more than 25 times the average earnings of the past 7 years. Modern takeaway. Graham's defensive strategy is in many ways the intellectual ancestor of modern passive investing. The easiest way for a defensive investor to implement his advice today is through low-cost index funds or ETFs. An S&P 500 index fund, for example, instantly gives you ownership in 500 of the largest and most prominent companies in the U.S. It provides perfect diversification and checks Graham's first two rules automatically. Many of these companies have long histories of paying dividends as well. The only thing the index fund doesn't do is control the price you pay. So, how can a modern defensive investor apply Graham's full strategy? They could adopt a 50-50 portfolio of a total stock market index fund and a total bond market index fund. Then, they would use Graham's rebalancing rule. When the stock market has a great year, they sell some of their stock fund and buy more of the bond fund. When the market crashes, they do the opposite. This is the essence of the Boglehead philosophy, named after Vanguard founder John Bogle, and it is pure Graham. This chapter is profoundly empowering. It shows that successful investing doesn't have to be complicated. You don't need to be a Wall Street genius. With a simple, disciplined, and logical plan, the average person can achieve excellent long-term results. Chapter 5, The Defensive Investor and Common Stocks. This chapter builds on the previous one, going deeper into the why behind owning stocks for the defensive investor. Graham is writing to an audience that is still deeply scarred by the 1929 crash and often views stocks as inherently risky and speculative. His job is to persuade them that not owning stocks is, in its own way, a bigger risk due to inflation. He argues that the primary advantage of stocks over bonds is their ability to protect purchasing power. Over the long run, the earnings of corporate America tend to grow, and this growth provides a cushion against both inflation and other economic risks. However, he immediately follows this with a strong warning. Just because stocks are good in general doesn't mean you can buy them blindly at any time and at any price. The risk in owning stocks comes not from the nature of the asset itself, but from the price you pay for it. He famously says, "The investor's chief problem, and even his worst enemy, is likely to be himself." He dismisses two popular but flawed approaches to stock selection. Simple growth stock picking. This is a strategy of trying to identify the companies that will grow the fastest in the future. Graham argues that this is extremely difficult. The future is uncertain, and often the most promising-looking growth stocks are already priced for perfection. If their growth slows even slightly, the stock can plummet. The price you pay is often too high to provide a margin of safety. Buying hot or fashionable stocks. This is pure speculation masquerading as investing. Buying a stock simply because it's popular or has gone up a lot recently is a recipe for disaster. The defensive investor must completely ignore the whims of the market and focus on underlying value. So, what is the right approach? It is the one he outlined in Chapter 4, buying a diversified portfolio of leading companies at reasonable prices. The key is discipline. The defensive investor must stick to their simple, proven criteria and resist the temptation to chase fads or try to be a market genius. The beauty of this approach, Graham explains, is that it doesn't rely on forecasting. You are not trying to predict which company will be the next superstar. Instead, you are buying a cross-section of corporate America, confident that over the long term, its collective earnings power will provide you with a satisfactory return. Your main job is to ensure you don't overpay for that stream of earnings. Modern takeaway. Graham's skepticism of growth stock investing is a crucial counterpoint to the modern narrative, especially in the tech world. Think about the obsession with finding the next Amazon or the next Apple. Venture capitalists and public market investors pour billions into companies that are burning through cash, hoping one of them will become a global giant. For every success story like Amazon, there are thousands of failures. Graham would argue that for the average defensive investor, try and pick the winner in this race is a loser's game. You are far more likely to end up with a portfolio of failed bets. His philosophy finds its modern expression in the factor investing movement, specifically the value and quality factors. Research by academics like Eugene Fama and Kenneth French has shown that, over the long term, stocks with characteristics Graham favored, like low price-to-earnings ratios, value, and high profitability quality, have tended to outperform the broader market. This is a quantitative validation of Graham's century-old principles. Look at the ARK Innovation ETF ARKK, managed by Cathie Wood. During 2020, it had a spectacular run by investing in disruptive, high-growth, often unprofitable tech companies. It was the epitome of the growth-at-any-price strategy. Many investors piled in at the top, drawn by the incredible past returns. However, when the market environment changed, the fund suffered catastrophic losses. A Graham-style investor would have looked at the valuations of the underlying companies in 2020 and concluded that there was no margin of safety and would have stayed away, avoiding the subsequent crash. This chapter's lesson is one of humility and realism. The defensive investor succeeds by accepting that they cannot predict the future and instead focusing on controlling the one thing they can, the price they pay for an asset. Chapter 6, Portfolio Policy for the Enterprising Investor. Negative approach, 956 words. Now Graham turns his attention to the enterprising investor. This is the active, more ambitious investor who is willing to put in the time and effort to try and beat the market averages. Interestingly, he starts not with what the enterprising investor should do, but with what they should not do. This negative approach is designed to steer the ambitious investor away from the most common and dangerous traps. Here are the 4 things the enterprising investor should generally avoid. High yield or low-grade bonds. Junk bonds when interest rates are low. It can be tempting to reach for higher yields by buying bonds from financially weaker companies. Graham warns that this is a bad trade-off. You are taking on stock-like risk for a bond-like, limited return. The extra few points of yield are rarely enough to compensate for the much higher risk of default. Foreign bonds. In his time, foreign bonds were often risky and difficult to analyze. While the world is different today, the underlying principle holds. Don't invest in things you don't understand or where you're at a significant information disadvantage. New issues. IPOs. Graham is extremely wary of initial public offerings. He points out that IPOs are almost always brought to market during bullish periods when the public is feeling optimistic. They are priced by sellers to extract the maximum possible value, often leaving very little on the table for the buyers. For every successful IPO like Google, There are countless others that trade below their offering price for years, buying on tips or hot information. This should be obvious, but it's a trap that ambitious investors often fall into. The desire for an edge can lead them to act on rumors or supposed inside information. Graham dismisses this as foolish. Any real information is likely already reflected in the price, and most tips are just noise. The core idea here is risk management. The enterprising investor's goal is to achieve superior returns, but this must be done through intelligent analysis, not by taking on foolish risks. By avoiding these common pitfalls, the investor can protect their capital and focus their energy on more promising areas. He is essentially clearing the playing field, telling the reader, don't look for easy shortcuts. Superior performance comes from hard work and discipline, not from chasing speculative fads. Modern takeaway. Graham's warnings are timeless. Let's look at them through a modern lens. High-yield bonds. The junk bond market is massive today. While it can offer high returns, it is also highly correlated with the stock market and suffers badly during recessions. A modern enterprising investor might use these sparingly, but only after deep credit analysis, just as Graham would have advised foreign bonds. Today, investing internationally is much easier through ETFs. However, the core warning remains. Investing in emerging market debt, for example, requires an understanding of currency risk, political risk, and local economic conditions that most individual investors simply do not have at IPOs. The IPO market of the last decade is a perfect illustration of Graham's point. Think of the hype around IPOs like WeWork, which failed, Peloton, or DoorDash. They came to market at peak valuations, buoyed by a compelling story, and many have since fallen dramatically. The sellers, venture capitalists, and founders made a fortune, while the public buyers were often left holding the bag. The modern equivalent of IPO mania is the SPAC, Special Purpose Acquisition Company, boom of 2020 to 2021, which has been an unmitigated disaster for most investors. Hot tips. This is a world of Reddit's Wall Street bets and stock-touting influencers on TikTok. The idea of a meme stock run as a modern-day hot tip, amplified by social media. It's a purely speculative activity based on herd mentality. And as Graham warned, it almost always ends badly for the majority of participants. This chapter serves as a crucial set of guardrails. Before an enterprising investor can win the game, they must first learn how not to lose it. Avoiding these high-risk, low-probability areas is the first step toward intelligent, active investing. Chapter 7. Portfolio Policy for the Enterprising Investor, the Positive Side. After warning the enterprising investor what to avoid, Graham now lays out the specific areas where they can apply their skill and effort to find superior returns. He emphasizes that these strategies are not for the passive or defensive investor. They require time, business acumen, and emotional control. He identifies four main areas for the enterprising investor to explore: buying in depressed markets and selling in booming markets. This is classic contrarian investing. It's the market timing version of his rebalancing advice for the defensive investor, but on a grander scale. The enterprising investor might let their stock allocation drift up to 75% when they believe the market is generally undervalued and down to 25% when they believe it is dangerously overvalued. This requires immense emotional fortitude to buy when everyone else is panicking and sell when everyone is euphoric, buying carefully chosen growth stocks. Graham is not entirely against growth stocks, but his definition is very different from a modern one. He is not looking for the fastest growing, most popular companies. Instead, he is looking for established, successful companies that are still growing but are available at a reasonable price. He would still demand a margin of safety and would not be willing to pay an extravagant price based on speculative future projections. He is looking for growth at a reasonable price, Garp, not growth at any price. Buying bargain issues of various types. This is the heart of Graham's value investing philosophy. It involves finding securities that are trading for significantly less than their intrinsic value. He breaks this down into a few categories. The net working capital approach. This is Graham's most famous and mechanical strategy. He would look for companies trading for less than their net current asset value, current assets minus total liabilities. In this scenario, you are essentially getting the business, the factories, brands, and future earnings potential for free. These opportunities are rare but offer an enormous margin of safety. Second-line companies. Looking for solid but less popular companies that are trading at a significant discount to their larger, more famous peers. Buy into special situations. Workouts. This involves investing in companies going through corporate events like mergers, acquisitions, spin-offs, or reorganizations. The outcome of the investment depends more on the successful completion of the corporate action than on the general movement of the stock market. This is a highly specialized area that requires significant expertise. Graham stresses that success in these areas is not easy. It requires a business-like mindset. You are not buying a ticker symbol. You are buying a piece of a business. This requires research, patience, and a firm conviction in your own analysis, especially when the market disagrees with you. Modern takeaway. How do these strategies hold up today? Market timing. While Graham suggested it for enterprising investors, most modern financial science argues against market timing. It is notoriously difficult to do consistently. However, the principle of being greedy when others are fearful and fearful when others are greedy is as relevant as ever. Warren Buffett's famous 2008 op-ed, "Buy American, I Am," published in the depths of the financial crisis, is a perfect example of this mindset. Growth stocks at a reasonable price. GARP. This is a very popular strategy today, famously practiced by investors like Peter Lynch. A modern GARP investor might look at a company like Microsoft or Google. They are still growing, but they are also mature, profitable giants. The investor's job is to wait for periods when the market sours on them temporarily, pushing their valuation down to a reasonable level, and then buy. Bargain issues. Net opportunities are very rare in major markets like the U.S. today, but they can still be found in less efficient markets like Japan or in micro-cap stocks. The broader concept of bargain hunting. Finding companies trading below their intrinsic value is the foundation of all modern value investing. A value investor today might look at a solid but boring company in an out-of-favor industry that has been unfairly punished by the market. Special situations. This is now a major strategy for sophisticated hedge funds, known as event-driven investing. It remains a complex field, generally outside the scope of the individual investor. This chapter shows that outperforming the market is possible, but it is hard work. There are no shortcuts. It requires diligence, a contrarian spirit, and an unwavering focus on buying assets for less than they are worth. Chapter 8. The Investor and Market Fluctuations. This is arguably the most important chapter in the entire book. It contains Graham's most famous allegory, the story of Mr. Market. This simple yet profound concept is the key to mastering the single biggest challenge in investing: your own emotions. Graham asks you to imagine that you own a share in a private business and have a partner named Mr. Market. Every day, Mr. Market shows up at your door and offers to either buy your share or sell you his at a specific price. The catch is that Mr. Market is a manic depressive. Some days he is euphoric. He sees nothing but a rosy future for the business and offers you a ridiculously high price for your share. Other days he is inconsolably pessimistic. He is convinced the business is on the brink of collapse and offers to sell you his share for pennies on the dollar. He is also very accommodating. You are free to ignore him completely. He'll be back tomorrow with a new price. The intelligent investor's relationship with Mr. Market should be purely transactional. You should be happy to sell to him when he is wildly optimistic and quotes a high price, and you should be delighted to buy from him when he is ridiculously pessimistic and offers a low price. But you should never, ever let his mood influence your own assessment of the business's value. His quotes are there to be taken advantage of, not to be followed. The speculator, on the other hand, makes the fatal mistake of letting Mr. Market be his guide. When prices are rising, the speculator gets excited and buys from Mr. Market at his euphoric highs. When prices are falling, the speculator panics and sells to Mr. Market at his depressed lows. The speculator is at the mercy of Mr. Market's mood swings. This allegory perfectly captures the irrationality of the stock market. The market is not a rational assessor of value in the short term. It is a pendulum that swings between unsustainable optimism and unjustified pessimism. The investor's job is not to ride the pendulum, but to take advantage of its extremes. Graham's central message is that you must not confuse the price of stock with the value of the underlying business. The price is what Mr. Market is shouting today. The value is what the business is truly worth based on its assets and earning power. Your success will depend on your ability to exploit the difference between the two. This means you should never buy a stock just because it is going up, and you should never sell stock just because it is going down. Your decision to buy or sell must be based on your own analysis of its value relative to its price. If you buy a stock at a sensible price, the fact that it goes down in the short term should not be a cause for panic. On the contrary, if the underlying business is still sound, Mr. Market's pessimism is giving you an opportunity to buy more at an even better price. Modern takeaway: Mr. Market is more hyperactive today than ever before. He's not just knocking on your door once a day. He's in your pocket on your phone, 24/7. Financial news networks, Twitter feeds, and trading apps provide a constant stream of price quotes and commentary, amplifying his manic-depressive mood swings. Consider the volatility of cryptocurrencies like Bitcoin. One day, Mr. Market is euphoric because of a favorable tweet or a corporate adoption announcement, and the price soars 20%. The next day, he's panicking over a regulatory rumor from China, and the price crashes 30%. An investor who lets Mr. Market dictate their actions will be whipsawed, buying high and selling low, leading to financial ruin. An intelligent investor, if they chose to participate, would have a firm idea what they think the asset is worth, if possible, and would use these wild swings to their advantage, or simply ignore the noise altogether. The meme stock phenomenon with GameStop and AMC is another perfect example. Mr. Market, fueled by social media, became completely detached from reality. The price of GameStop rocketed to levels that had no connection to the company's struggling business fundamentals. Those who bought at the top were listening to Mr. Market's euphoria. Those who panicked and sold at the bottom were listening to his despair. The intelligent investor would have stayed on the sidelines, recognizing that the game being played had nothing to do with business value. The wisdom of Mr. Market is the ultimate antidote to FOMO and panic. It teaches you to view market volatility not as a threat, but as an opportunity. It transforms you from a passive victim of market moods into an active exploiter of them. This single chapter, if truly internalized, is worth more than a library of books on technical analysis and market forecasting. Chapter 9, Investing in Investment Funds. In this chapter, Graham turns his attention to investment funds, which his day were primarily closed-end funds and the early forms of mutual funds. He provides a practical guide for investors who want to use funds as a way to achieve diversification and professional management. Graham is a fan of the concept of investment funds, especially for the defensive investor. He sees them as a simple and effective way to own a broad portfolio of stocks without having to do the research on individual companies. However, he is very critical of the fund industry itself. He points out two major problems. Performance. Graham presents data showing that, on average, investment funds do not outperform the broader market averages. While some funds will have periods of great performance, this is often due to luck rather than skill, and they rarely maintain that outperformance over the long term. He concludes that the promise of professional management leading to superior results is largely a myth. Fees and costs. Funds charge management fees, and in his day, they often had high sales loads, commissions paid to brokers who sold them. Graham demonstrates that these costs act as a significant drag on performance. A fund that charges a 1% management fee has to outperform a market by 1% each year just to break even with a simple index. Over time, this fee hurdle makes it almost impossible for the vast majority of funds to beat the market. Given these realities, Graham's advice on selecting a fund is characteristically pragmatic and cautious. He tells investors to ignore a fund's recent performance. A fund that was a top performer for the last 3 years is just as likely to be a bottom performer for the next 3. Past performance is not a reliable predictor of future results. Instead, he advises investors to focus on two things: a consistent and conservative investment policy. Choose a fund that has a clear, understandable, and long-standing strategy. Avoid funds that change their approach based on the latest market fads. A low-cost structure. This is paramount. Since you can't predict performance, the one thing you can control is the cost you pay. Choose the funds with the lowest management fees and avoid those with high sales loads. He also discusses closed-end funds, which trade on the stock exchange like regular stocks. He notes that these funds sometimes trade at a significant discount to their net asset value (NAV). This means you could buy $1 worth of assets for 85 or 90 cents. For the enterprising investor, buying a diversified portfolio of sound stocks at a discount through a closed-end fund could be an attractive opportunity. Modern takeaway. Graham's analysis of the fund industry was incredibly prescient. He was, in essence, making the case for passive index investing decades before Jack Bogle launched the first index fund for individual investors in 1976. His conclusions have been proven correct by countless modern studies. The vast majority of actively managed mutual funds fail to beat their benchmark index over any meaningful period, especially after fees are taken into account. The fund industry's marketing still focuses on star managers and past performance, the very things Graham warned us to ignore. Today, the best way to apply the wisdom of this chapter is simple: buy low-cost index funds or ETFs. A fund like the Vanguard Total Stock Market Index Fund, VDSEX, or an ETF like SPY, SPDR S&P 500 ETF, perfectly aligns with Graham's advice. They have a clear, consistent policy, own the entire market. They offer complete diversification. Their costs are incredibly low, often just a few hundredths of a percent per year. For the modern investor, the debate between active and passive management is largely settled in Graham's favor. The surest way to get your fair share of the market's returns is to buy the entire market through a low-cost index fund and hold on. What about his idea of buying closed-end funds at a discount? This is still a viable strategy for enterprising investors. There are still funds that trade at discounts to their NAV, and for those willing to do the research, it can be a way to add an extra layer of margin of safety to their investments. However, for most people, the simplicity and ultra-low cost of index fund ETFs make them the superior choice. This chapter is a powerful indictment of the high-fee financial industry and a ringing endorsement of the simple, elegant solution of passive investing. Chapter 10, The Investor and His Advisors. Having discussed funds, Graham now tackles the broader world of financial advice. In an industry filled with salespeople, brokers, and forecasters, how can an intelligent investor find trustworthy guidance? Graham is, as always, deeply skeptical. He knows that much of the financial industry is built on salesmanship, not on providing objective advice. He outlines the different types of advisors an investor might encounter. Brokerage firms. The primary business of a brokerage firm is to execute trades. Their analysts and brokers may offer advice, but their income is often tied to the volume of trading their clients do. This creates a fundamental conflict of interest. They are incentivized to encourage activity, which is often detrimental to the investor's long-term returns. Investment bankers. Their main role is to help companies raise capital by issuing stocks and bonds. Graham sees them as sellers, not as objective advisors for the average investor. Financial services and tip sheets. These are publications or services that offer stock recommendations. Graham is dismissive of most of them, seeing them as little more than glorified fortune tellers. He notes that their track records are typically poor and their advice is often geared toward speculation, not investment. Investment counselors, financial advisors, this is a category Graham sees as having the most potential for providing real value. A good investment counselor, he argues, should act like a doctor or a lawyer. They should be a fiduciary, legally obligated to act in their client's best interest. Their compensation should be based on a fee for advice, not on commissions from selling products. His advice on choosing an advisor is simple and direct. Check for competence and integrity. Look for someone with a long track record of ethical behavior. Be wary of anyone who promises high returns or claims to have a secret formula for beating the market. Understand their motives. How are they paid? If their income depends on you buying a certain product or trading frequently, their advice is inherently conflicted. Seek out fee-only advisors. The advisor's role, a good advisor's primary role, is not to pick hot stocks. It is to help the client build a sound, long-term portfolio policy, to provide discipline, and protect the investor from their own worst emotional impulses. The advisor's value is often in telling you no. No, you shouldn't chase a hot tech stock. No, you shouldn't sell everything during a panic. Ultimately, Graham believes that the investor must take responsibility for their own education. Even with a good advisor, you must understand the basic principles of sound investing yourself. An advisor can provide guidance and discipline, but they cannot save you from the consequences of your own ignorance or greed. Modern takeaway. The world of financial advice has changed, but the core challenges remain. The internet and social media have created a new army of self-proclaimed gurus and finfluencers on platforms like TikTok, YouTube, and Instagram. They often flash a lavish lifestyle and offer simplistic advice or sell expensive courses promising to teach the secrets of wealth. Graham would see this as the modern equivalent of the snake oil salesman's tip sheet, dangerous and best avoided. His advice on finding a good advisor is more important than ever. The key term to look for today is fiduciary. In the United States, registered investment advisors, RIAs, are held to a fiduciary standard. Brokers, on the other hand, are often held to a lower suitability standard, which means they only have to recommend products that are suitable for you, not necessarily what is in your absolute best interest. The rise of robo-advisors like Betterment and Wealthfront is an interesting modern development. These services use algorithms to create and manage a diversified portfolio of low-cost ETFs based on your risk tolerance and goals. In many ways, they are the perfect advisor for a Graham-style defensive investor. They are low-cost, they enforce discipline through automatic rebalancing, and they remove emotion from the equation. Graham would likely have been a big fan of this model. This chapter is a timeless lesson in due diligence. Be skeptical, ask questions, and never outsource your thinking completely. Whether you're choosing a stock, a fund, or an advisor, the responsibility for your financial future ultimately rests with you. Chapter 11, Security Analysis for the Lay Investor, General Approach. In this section, Graham begins to transition from broad portfolio policy to the details of analyzing individual securities. This chapter is a conceptual framework for the lay investor, not a professional analyst, on how to think about valuing a stock. He starts by making a crucial distinction. You are not analyzing a stock. You are analyzing a business. The fundamental question is, what is this business worth? Graham suggests a two-part process for security analysis. Valuing the business. First, you must determine the intrinsic value of the company. He suggests a value based primarily on its historical earning power. He is skeptical of forecasting future earnings too far out, as the future is inherently uncertain. Instead, he prefers to look at a company's average earnings over a number of years in the past, e.g., the last 7 to 10 years, to get a sense of its normalized earning capability through a full business cycle. Comparing value to price. Once you have an estimate of the business's value per share, you compare it to the current market price per share. If the price is significantly below your calculated value, you have a potential investment. That gap between value and price is your margin of safety. He then outlines a simplified framework for analyzing a common stock, focusing on 5 key factors. General long-term prospects. What is the outlook for the business? Is it in a growing or declining industry? Does it have a sustainable competitive advantage? Quality and competence of management. Is the management team honest and capable? Do they have a track record of creating value for shareholders? Financial strength and capital structure. The company must have a strong balance sheet. Graham likes to see low levels of debt. A company with too much debt is vulnerable in a downturn. He suggests that current assets should be at least twice the current liabilities, the current ratio, and that long-term debt should not exceed net current assets. Dividend record. A long, uninterrupted history of paying dividends is a strong positive sign. It demonstrates financial stability and a shareholder-friendly culture. Current dividend rate. The dividend yield, the annual dividend divided by the stock price, provides a direct return to the investor. He emphasizes that this is not a rigid checklist. It's a way of thinking. The goal is to build a complete picture of the business as a going concern. He also introduces a simplified formula for valuing a growth stock, which multiplies normalized earnings by a factor based on expected growth rate. However, he treats it with great caution, warning that such formulas can create a false sense of precision. The future is always uncertain, and any valuation is just an estimate. Modern takeaway. While Graham's specific valuation metrics might seem a bit dated, he wrote before the widespread availability of computers and financial data. The underlying principles are the foundation of all modern security analysis. Today, an investor has access to an incredible amount of information. Websites like Yahoo Finance, Morningstar, and the SEC's EDGAR database provide detailed financial statements for free. You can easily calculate key ratios like the PE ratio, price-to-book ratio, and debt-to-equity ratio. A modern investor applying Graham's principles would still focus on the same core ideas. Understanding the business. They would read the company's annual report, the 10K, study its competitors, and try to understand its moat or competitive advantage. Analyzing the financials, they would look for a history of consistent profitability, a strong balance sheet with manageable debt, and a record of returning cash to shareholders through dividends or buybacks. Valuation. They might use a discounted cash flow DCF model, which is a more sophisticated version of Graham's earnings-based valuation to estimate intrinsic value. But they would treat the output of the model with the same skepticism Graham had for his formulas, understanding it's an estimate, not a fact. Think about analyzing a company like Apple. A Graham-style analysis wouldn't just focus on the next iPhone release. It would look at the company's fortress-like balance sheet, huge cash pile, manageable debt, its incredible brand loyalty and ecosystem, its moat, its long history of massive profitability, and its commitment to returning capital to shareholders. The final step would be to determine if, at the current price, the stock offers sufficient margin of safety. This is a far more robust process than just buying the stock, because you like its products. Chapter 12. Things to consider about per-share earnings. This chapter is a masterclass in financial skepticism. Graham teaches the investor to look at a company's reported earnings per share, EPS, the most commonly cited financial metric, with a critical eye. He knew that accounting rules allow for a lot of leeway, and management can use various tricks to make their earnings look better than they really are. He warns investors to be on the lookout for several potential distortions. Accounting changes. A company can sometimes boost its reported earnings simply by changing its accounting methods, for example, by altering how it values inventory or depreciates its assets. These are paper profits that don't reflect any real improvement in the underlying business, non-recurring or extraordinary items. Companies often have one-time gains or losses, such as selling off a factory or settling a lawsuit. Management often tries to encourage investors to focus on pro forma or adjusted earnings that exclude the bad one-time items, while happily including the good ones. Graham insists on looking at the GAAP, generally accepted accounting principles, earnings over a long period to get a true picture. Depreciation and amortization. These are non-cash charges that are meant to reflect the wearing out of a company's assets. Management can use aggressive or conservative assumptions here, which can significantly impact reported profits. Share dilution. Companies often issue stock options to executives and employees. When these options are exercised, the number of shares outstanding increases, which dilutes the ownership stake of existing shareholders and reduces the earnings per share. Graham's main prescription is to smooth out earnings. Don't get too excited about one great year of earnings or too pessimistic about one bad year. He strongly advises investors to calculate the average earnings over a longer period, like 7 or 10 years, to get a sense of the company's true, normalized earning power. This process smooths out the effects of the business cycle and accounting manipulations. He also emphasizes the importance of looking at the quality of earnings. Are the earnings coming from the company's core, sustainable business operations, or are they from one-off events and accounting tricks? $1 of earnings from a dominant, stable business is worth far more than $1 of earnings from a highly cyclical company or one using aggressive accounting. Modern takeaway. This chapter is more important today than when it was written. The use of adjusted or non-GAAP earnings has become rampant. Almost every company now reports its own custom version of earnings, which invariably looks better than the official GAAP number. They might exclude things like stock-based compensation, restructuring charges, or acquisition-related costs. A modern intelligent investor must be incredibly skeptical of these adjusted numbers. They should always start with the official GAAP financial statements and understand exactly what management is excluding and why. The issue of stock-based compensation, which Graham touched on with stock options, is a huge deal in the tech industry today. Companies like Meta, Facebook, and Alphabet Google pay their employees billions of dollars in stock grants each year. This is a very real expense. as it dilutes existing shareholders. However, these companies often encourage investors to focus on adjusted earnings that exclude this cost. A Graham-style investor would insist on looking at the true GAAP earnings to understand the full cost of running the business. Similarly, the rise of share buybacks adds another layer of complexity. Companies can boost their EPS simply by reducing the number of shares outstanding. While buybacks can be a good way to return capital to shareholders if the stock is undervalued, they can also be used to mask stagnant underlying profit growth. The intelligent investor must look at the growth in total net income, not just a per-share number. Graham teaches us to be financial detectives. Read the footnotes of the financial statements, question management's narrative, and always focus on the long-term, normalized reality of the business. Chapter 13. A comparison of 4 listed companies. In this brief chapter, Graham puts his analytical principles into practice by comparing 4 real companies from his time. The specific company names are not important. The purpose is to illustrate the process of comparison. He demonstrates how 2 companies in the same industry can have very different investment merits. One might have a stronger balance sheet, a more stable record of earnings, and a more conservative valuation, making it a suitable investment. Its competitor might be burdened with debt, have volatile earnings, and be trading at a speculative price, making it a poor choice. The exercise highlights the importance of not just analyzing a company in isolation, but also in relation to its direct competitors. This comparative analysis can reveal strengths and weaknesses that might not be apparent otherwise. For example, if one company has consistently higher profit margins than its peers, it might be a sign of a strong competitive advantage. If another company relies much more heavily on debt, it might be a sign of underlying weakness. This chapter serves as a practical, hands-on workshop. It moves the reader from abstract principles to concrete application. The key takeaway is that security analysis is not about finding a good company. It is about finding a good investment. A great company can be a terrible investment if its price is too high, while a mediocre company can be a great investment if its price is low enough and it meets basic standards of financial health. The comparison process helps the investor make these crucial distinctions. Modern takeaway. This method is fundamental to how professional analysts work today. No one analyzes a company like Ford in a vacuum. They compare its growth rates, profit margins, balance sheet, and valuation to competitors like General Motors, Toyota, and even newer players like Tesla. A modern investor could apply this by, for example, comparing 2 retail giants like Walmart and Target. They would look at their revenue growth, same-store sales, gross margins, inventory turnover, debt levels, and P ratios. This comparison will provide a much richer understanding of each company's competitive position and investment appeal than looking at either one alone. This chapter reinforces the idea that investing is a game of relative choices. Your goal is to find the best available opportunity, and that requires comparing potential investments against each other to see which one offers the most attractive combination of business quality and price. Chapter 14. Stock Selection for the Defensive Investor. Graham returns to the defensive investor and provides a clear, actionable checklist for selecting individual stocks, should they choose to go beyond an index fund. These criteria are designed to be simple, objective, and focus on minimizing risk. He lays out 7 criteria for a stock to be included in a defensive investor's portfolio. Adequate size of enterprise. The company should be of a certain minimum size. Graham is wary of small companies because they can be more volatile and vulnerable to economic downturns. He suggests a minimum that, in today's terms, would likely translate to a market capitalization in the billions of dollars, i.e., a large cap stock that has sufficiently strong financial condition. This is a balance sheet test. He reiterates his rule that current assets should be at least double current liabilities, a current ratio of 2 to 1, and long-term debt should not exceed working capital, current assets minus current liabilities. This ensures a company is not overly reliant on debt. Earning stability. The company must have a consistent record of profitability. Graham suggests looking for positive earnings in each of the last 10 years. This demonstrates resilience and the ability to navigate through different economic conditions. Dividend record. He requires a long and uninterrupted history of dividend payments, suggesting at least 20 consecutive years. This is a powerful signal of financial health and a shareholder-friendly management. Earnings growth. There must be some history of growth. He suggests a minimum increase of at least 1/3 in per-share earnings over the past 10 years, using 3-year averages at the beginning and end of the period to smooth things out. This is a very modest growth requirement, designed simply to ensure the company is not stagnant. Moderate price/earnings ratio. The stock's current price should not be more than 15 times its average earnings over the past 3 years. This is a strict valuation discipline to prevent the investor from overpaying. Moderate ratio of price to assets. The current price should not be more than 1.5 times the book value of the company's assets. As a combined rule, he suggests that the P/E ratio multiplied by the price-to-book ratio should not exceed 22.5. Graham acknowledges that it can be difficult to find companies that meet all 7 of these stringent criteria, especially in a bull market. The point of the checklist is discipline. It forces the investor to be patient and to only buy when a high-quality company is available at a reasonable price. If no such opportunities can be found, the defensive investor should simply stick to index funds or bonds. Modern takeaway. This checklist is the essence of quality and value factor investing. Many modern quantitative strategies and smart beta ETFs are built on these very principles. For example, you can find ETFs today that screen for stocks with characteristics like low P ratios value, strong balance sheets quality, stable earnings growth quality, high dividend yields value/quality. A modern defensive investor could build a portfolio of these factor ETFs, or use an online stock screener to find individual companies that meet Graham's criteria. The tools have changed, but the logic is identical. Let's think about a company like Microsoft in the early 2010s. After the dot-com bust, it was considered a boring, has-been tech company. However, it would have met most of Graham's criteria. It was huge, had a fortress balance sheet, was incredibly profitable, paid a growing dividend, and was trading at a very low P/E ratio. An investor who followed these rules would have bought a wonderful business at a very cheap price and would have been rewarded handsomely over the next decade. In contrast, during the tech boom of 2020 to 2021, very few, if any, popular tech stocks would have passed Graham's valuation tests, criteria 6 and 7. This disciplined approach would have kept the defensive investor out of the most speculative and overvalued parts of the market, protecting them from the subsequent crash. Chapter 15, Stock Selection for the Enterprising Investor. For the enterprising investor, Graham offers a less rigid, more intellectually demanding set of strategies. He assumes this investor has the time, skill, and temperament to go beyond the simple checklist of the defensive investor. He doesn't provide a single formula, but rather a set of approaches that require business judgment and deep research. The key is to find value that is not obvious to the average market participant. The main strategies he outlines are the net-net approach. This is his most famous bargain hunting technique. The goal is to find companies trading at a price below their net current asset value or working capital. He suggests buying a diversified basket of these sub-asset value stocks. He acknowledges that these are often mediocre or even poor businesses, but the statistical advantage of buying assets for 50 or 60 cents on the dollar is so great that, as a group, they are likely to produce excellent returns. The margin of safety is enormous to second-line companies. The enterprising investor can look for relatively unpopular large companies or leading companies in less important industries. These second-line companies often get overlooked by the market and can sometimes be bought at much cheaper valuations than the popular blue-chip giants, even if their financial strength and stability are quite good. Special situations or workouts. This involves investing in securities involved in complex corporate events like mergers, spin-offs, liquidations, or bankruptcies. The return on these investments depends more on the successful completion of the event, not on the overall market direction. This is a highly specialized field that requires a level of expertise similar to that of a lawyer or banker. Graham is clear that these methods are hard work. Analyzing a potential net requires carefully scrutinizing the balance sheet to make sure the assets are real and not overstated. Digging into special situations requires reading complex legal and financial documents. The common thread is a search for a large discrepancy between price and value. The enterprising investor is a bargain hunter, always looking for opportunities that the market has mispriced due to neglect, complexity, or temporary pessimism. Modern takeaway. While the investment landscape has changed, these enterprising strategies are still practiced today, primarily by professional value-oriented hedge funds. Net-nets. As mentioned before, true net-nets are rare in the U.S. market, but can still be found in international markets, particularly Japan, or in the very smallest microcap stocks. Investors like Warren Buffett made their early fortunes using this exact strategy. Today, it requires specialized screening tools and a willingness to invest in obscure, often ugly-looking companies, second-line companies. This is a very viable strategy. Think about industries that are currently out of favor. Perhaps it's a boring industrial manufacturer, a regional bank, or a consumer staples company that the market has written off as having no growth. An enterprising investor can do the work to see if the market's pessimism is overblown and if the company is available at a bargain price. Special situations. This remains sophisticated niche. Activist investors like Carl Icahn or Bill Ackman are essentially modern practitioners of this, trying to force corporate changes to unlock value. For individual investors, the complexity and risk are usually too high. The overarching lesson for the modern enterprising investor is that to beat the market, you must think differently from the market. You cannot buy what is popular and expect to have above-average returns. You must be willing to do the hard work of analysis, be patient, and have the courage to buy what is unpopular and overlooked. Chapter 16, Convertible Issues and Warrants. This is a more technical chapter where Graham discusses hybrid securities like convertible bonds and warrants. These are instruments that have characteristics of both stocks and bonds. A convertible bond is a type of bond that the holder can convert into a specified number of shares of common stock in the issuing company. It offers the safety of a bond, regular interest payments and return of principal at maturity, along with the potential upside of a stock. If the stock price goes up, the conversion feature becomes valuable. A warrant is a security that gives a holder the right, but not the obligation, to buy a company stock at a specific price, the strike price, before a certain expiration date. Warrants are often issued along with bonds or other securities as a sweetener. They are highly speculative, essentially a long-term call option. Graham's analysis is, as usual, focused on value and risk. For convertible bonds, he sees them as a potentially attractive option for the enterprising investor, but only if they can be bought at a price that is not much higher than their value as a straight bond, their investment value. In this case, the investor gets a bond-like downside protection with a stock-like upside potential for a small premium. However, he warns that convertibles are often issued by weaker companies and are frequently overpriced, with the conversion privilege being sold at a high premium. For warrants, he is almost entirely negative. He sees them as inherently speculative instruments. Their value is entirely dependent on the stock price rising above the strike price, and if that doesn't happen by the expiration date, the warrant becomes worthless. He views them as a form of corporate manipulation that creates value for insiders and speculators at the expense of long-term investors. Modern takeaway. The principles in this chapter are still relevant. Convertible bonds are still a part of the market, often used by growth-oriented companies to raise capital at a lower interest rate than they could with a straight bond. A modern value investor would analyze them just as Graham did. First, value the bond component on its own merits. Then, assess how much extra you are paying for the conversion option. If the price is right, it can be an interesting heads I win, tails I don't lose much proposition. Warrants are less common for individual investors today, but their modern cousin, the stock option, is everywhere. The speculative nature of options trading on platforms like Robinhood is a perfect example of what Graham warned against. People are buying short-dated call and put options, which are very similar to warrants, making all-or-nothing bets on short-term price movements. This is pure gambling, not investing. Graham's disdain for warrants would undoubtedly extend to the speculative frenzy in the options market today. Chapter 17. For extremely instructive case histories. Similar to Chapter 13, this chapter uses real-world examples to drive home Graham's key lessons. He presents 4 detailed case studies of companies whose stock prices went through extreme fluctuations. The point of these stories is to show how Wall Street's perception and valuation of a company can swing from one absurd extreme to another. The cases illustrate common market pathologies. A stable, profitable utility company whose stock price collapses due to temporary negative sentiment, creating a fantastic buying opportunity. A large corporation that falls on hard times, with its stock price plummeting to a fraction of its working capital, only to recover spectacularly later. The company that uses complex and deceptive accounting to hide its problems, leading to an eventual collapse to the company that undergoes a dramatic leverage buyout and restructuring, with its various securities behaving in complex and unpredictable ways. Through these stories, Graham hammers home several of his core themes. The market is often irrational in the short term, that a strong balance sheet is crucial for surviving tough times. Thorough analysis of financial statements is essential to avoid being misled by accounting tricks. Enormous opportunities can be found in unpopular and neglected securities. The future is inherently unpredictable, and a large margin of safety is your best protection. These are not just dry academic examples. They are gripping financial dramas that show the real-world consequences of investment principles, both good and bad. Modern takeaway. We are surrounded by modern case studies that echo Graham's examples. The financial crisis of 2008. Banks like Wells Fargo and JP Morgan Chase, despite their problems, were fundamentally sound institutions whose stock prices collapsed to absurdly low levels due to panic. Investors who had the courage and analytical skill to buy them in late 2008 and early 2009 made fortunes. Accounting scandals. The collapse of companies like Enron 2001 and Wirecard 2020 are modern textbook examples of massive accounting fraud that Graham warned about. Investors who took the glossy headline numbers at face value were wiped out, while skeptical analysts who dug into the footnotes saw the warning signs. The COVID crash of 2020. In March 2020, the entire market panicked, and solid companies in industries like travel and hospitality were priced as if they were going bankrupt tomorrow. An investor who applied Graham's principles would have analyzed their balance sheets to see which ones could survive the shutdown and would have found incredible bargains. This chapter reminds us that studying financial history and specific company case studies is one of the best ways to learn. The names and industries change, but the patterns of business success and failure and of market folly and wisdom repeat themselves over and over again. Chapter 18. A comparison of 8 pairs of companies. This is another practical, case study-driven chapter. Here, Graham takes 8 pairs of companies from the same industry and compares them head-to-head. In each pair, one company is a large, famous industry leader, while the other is a smaller, less prominent competitor. He analyzes their financial performance, balance sheets, and market valuations over a long period. The results are often surprising. In many cases, the smaller, second-line company, which was available at a much lower valuation, produced significantly better returns for investors than the famous blue-chip leader. The purpose of this exercise is to challenge the investor's assumptions. It's easy to assume that the biggest and best-known company is always the best investment. Graham shows that this is often not the case. The market tends to overvalue the popular leaders, pricing them for perfection, while undervaluing their less glamorous but still solid competitors. This provides a fertile hunting ground for the enterprising investor. By looking beyond the obvious choices and doing the analytical work on these runner-up companies, it's often possible to find better bargains and, therefore, superior long-term returns. The key, as always, is the price you pay. The less popular company may offer a much larger margin of safety. Modern takeaway. This is a powerful and timeless investment strategy. Think about the market's obsession with a handful of giant tech stocks, the FANGs. An investor applying Graham's comparative approach might ask, are there other, less famous software companies or semiconductor firms that are growing just as fast, have equally strong financials, but trade at half the valuation? For example, for years, Apple has been the dominant smartphone maker, but an investor might have compared it to a key supplier, like the semiconductor manufacturer TSMC, Taiwan's semiconductor manufacturing company. They might have concluded that TSMC had a more attractive valuation and an equally strong competitive position, making it the better investment at that time. Or consider the rivalry between Coca-Cola and PepsiCo. For decades, investors have debated which is a better investment. A Graham-style analysis would force you to ignore the brand preference and focus on the numbers. Which one has better growth, higher margins, a stronger balance sheet, and, most importantly, a more attractive valuation today? This chapter teaches us to be skeptical of reputation and popularity. The best business is not always the best stock. The enterprising investor's job is to look where others are not looking and to find value that the market has overlooked. Chapter 19, Shareholders and Management's Dividend Policy. In this chapter, Graham addresses the relationship between a company's shareholders, the owners, and its management, the employees who run the company. He argues that this relationship has often become dysfunctional, with managements running companies for their own benefit rather than for the benefit of the owners. His main focus is on dividend policy. Graham is a strong believer in dividends. He sees consistent and growing dividend as the most tangible evidence that a company is profitable and that its management is focused on shareholder returns. He is very critical of companies that retain all of their earnings in the name of growth, yet fail to generate a satisfactory return on that reinvested capital. He argues that if a company's management cannot find profitable investment opportunities within the business that will earn a high rate of return, they have a duty to return that capital to the shareholders in the form of dividends. The shareholders can then reinvest that money elsewhere. He presents data showing that, historically, a large portion of the stock market's total return has come from dividends, not just price appreciation. By neglecting dividends, he argues, companies are depriving shareholders of a key component of their return and are often wasting capital on mediocre projects or empire-building acquisitions. He encourages shareholders to be more active and to hold management accountable. They should question the company's dividend policy and demand that management justify their decision to retain earnings rather than pay them out. Modern takeaway. The debate over dividends versus reinvestment is still very much alive today. Many modern growth companies, especially in the tech sector, pay no dividends at all. Companies like Amazon and Tesla have famously retained all of their earnings to fund their massive growth initiatives. Their argument is that they can generate a much higher return on that capital by reinvesting it in their business than a shareholder could by receiving it as a dividend. In the case of highly successful companies like these, that has certainly been true. However, Graham's point remains valid for the vast majority of businesses. There are countless mature, stable companies that generate more cash than they can profitably reinvest. In these cases, returning capital to shareholders is the most efficient and value-creating thing to do. The modern form of returning capital has expanded beyond just dividends. Share buybacks have become extremely popular. When a company buys back its own stock, it reduces the number of shares outstanding, which increases the ownership stake of the remaining shareholders and boosts earnings per share. A Graham-style investor would analyze buybacks with a critical eye. If a company is buying back its stock when it is trading below its intrinsic value, it's a great way to create value for shareholders. But if it's buying back stock at an overvalued price, it's actually destroying value. The intelligent investor must assess whether the buyback program is a smart allocation capital or just a way to financially engineer a higher EPS number. This chapter is a call for an owner's mindset. When you buy a stock, you are not just buying a piece of paper. You are becoming a part owner of a business, and you have the right to question whether management is acting in your best interest. Chapter 20, Margin of Safety as the central concept of investment. We have arrived at the final and most important chapter. Graham saves a central, unifying concept for last, the margin of safety. If you remember only 3 words from this entire book, they should be these. What is the margin of safety? In simple terms, it means buying a security for a price that is significantly below your estimate of its intrinsic value. It is the buffer between the price you pay and the value you get. Graham illustrates this with a simple analogy. If you are building a bridge and you calculate that it needs to hold a weight of 10,000 pounds, you don't build it to hold exactly 10,000 pounds. You build it to hold 15,000 or 20,000 pounds. That extra capacity is your margin of safety. It protects you from miscalculations, unforeseen problems, or bad luck. Investing works the same way. Your estimate of a company's intrinsic value is just that, an estimate. You could be wrong. The future earnings you project might not materialize. The industry might face an unexpected challenge. The margin of safety is what protects you from these errors in judgment and the vicissitudes of the future. If you estimate a stock is worth $100 per share, you don't buy it at $95. that offers very little room for error. You wait until Mr. Market is in one of his pessimistic moods and offers it to you for $60 or $70. That $30 or $40 discount is your margin of safety. This principle provides two key benefits. It cushions you against losses. If you are wrong about the value and it turns out to be worth only $80, you still haven't lost money if you bought it at $60. It provides a higher potential for return. When the market eventually recognizes the true value of the business, the stock's price is likely to rise from your bargain purchase price, giving you a handsome profit. The entire philosophy of value investing is built on this concept. The various strategies Graham has discussed, buying net-nets, looking for low PE and low price-to-book stocks, finding unpopular companies, are all just different methods for finding a margin of safety. He contrasts this with the speculator's approach. The speculator often buys stocks with little to no margin of safety. They buy a popular growth stock at 100 times earnings, betting that future growth will be even more spectacular than the market already expects. In this scenario, anything less than perfection can lead to a catastrophic loss. There is no buffer for disappointment. The margin of safety is the secret to both preserving capital and achieving satisfactory returns. It is the cornerstone of intelligent investing. Modern takeaway: the margin of safety concept is timeless and universal. It is the ultimate defense against an uncertain future and the irrationality of the market. In the modern market, the search for a margin of safety is more important than ever, precisely because the opportunities for speculation are so plentiful and tempting. When you buy a story stock with no earnings, you have no margin of safety. Your investment depends entirely on a speculative future coming to pass. When you buy a cryptocurrency with no cash flows or tangible assets, it is difficult, if not impossible, to calculate an intrinsic value. Therefore, it's almost impossible to know if you're buying with margin of safety. When you pay 50 times revenue for a hot SaaS, software as a service, company, your margin of safety is razor thin or non-existent. You are paying a price that assumes decades of flawless execution and growth. Conversely, a modern value investor finds their margin of safety in the unloved corners of the market. They might find it in a solid industrial company that the market has written off due to fears of recession. They might find it in a healthcare company whose stock has been punished because of a temporary setback with a single drug. They do the work to estimate the business's long-term value and wait patiently for the price to fall far below that value. The margin of safety is not just a technical concept. It's a philosophy of prudence, humility, and realism. It is the single most powerful idea for protecting yourself and from the madness of the crowd. Modern context expansion. What would Graham say today? The tools of the trade, Robinhood, AI, and high-frequency trading. Having looked into the core of Graham's wisdom, let's engage in a thought experiment. If we could bring Benjamin Graham into our modern financial world, what would he think? What would he say about the technologies, strategies, and psychologies that define investing in the 21st century? He would be both horrified and, in a strange way, vindicated. First, Graham would be astonished by the democratization of market access. The idea that anyone, anywhere, could buy or sell a stock for zero commission instantly from a device in their pocket would seem like science fiction. He, who had to rely on mailed annual reports and telephone calls to a broker, would marvel at the sheer volume of information available to the average person. However, his astonishment would quickly turn to deep concern. He would look at an app like Robinhood and see a platform perfectly designed to encourage speculation, not investment. The confetti animations, the top movers lists, the easy access to options in cryptocurrency. He would see these as tools that amplify Mr. Market's manic depressive tendencies. He would argue that by removing friction and costs, these apps have dangerously blurred the line between investing and gambling, tricking a new generation into thinking they are Warren Buffett, when they are actually just sitting at a slot machine. He would be fascinated by the rise of quantitative models and AI-based investing. As a man who loved data and systematic approaches, he would appreciate the raw power of these tools. He would likely see quantitative value strategies, algorithms that screen for stocks with low P/E ratios, high dividend yields, and strong balance sheets as the ultimate evolution of his own statistical methods. He could automate the search for bargain issues on a global scale. But he would be deeply skeptical of AI models that claim to predict market movements. This would strike him as the same old fortune-telling, just dressed up in more sophisticated clothes. He would warn that any model based on past data is vulnerable to a black swan event, a future that looks nothing like the past. His faith will remain in the timeless principles of business valuation, not in the predictive power of complex algorithms. Similarly, high-frequency trading HFT, where computers execute millions of trades in seconds, would be something he'd view as the ultimate form of speculation. It has nothing to do with the analysis of business value. He would likely see it as a parasitic tax on real, long-term investors, adding liquidity with one hand while increasing volatility and fragility with the other. The modern strategies, index funds versus day trading. Graham's philosophy provides a powerful lens through which to view the dominant investment strategies of today. His reaction to index funds would be overwhelmingly positive. In fact, he practically invented the intellectual case for them. He would see low-cost, broadly diversified index funds as a perfect, if not the only, appropriate tool for the vast majority of defensive investors. It solved the problems of diversification, high fees, and the futility of trying to pick winning stocks or funds. He would likely see Jack Bogle, the founder of Vanguard, as his philosophical successor, having taken his ideas and operationalized them for the masses, saving investors trillions of dollars in fees in the process. On the other end of the spectrum is day trading. Graham would view the modern-day trading culture, fueled by social media and commission-free apps, with utter contempt. He would see it as the purest form of speculation, a zero-sum game, or more accurately, a negative-sum game after costs and taxes, where participants are not investing in businesses but are simply betting on fleeting price wiggles. He would point out that the hows, the market makers and sophisticated institutions, almost always wins in the end. He would repeat his core mantra: your results as an investor depend on the behavioral and analytical edge you have, and the average day trader has neither. Timeless principles as a shield against modern risks. In this world of unprecedented speed, hype, and complexity, Graham's principles are not obsolete. They are more essential than ever, acting as a shield against modern risks. Investor versus speculator. This simple distinction is the antidote to the FOMO generated by social media. When you see a meme stock or a cryptocurrency soaring, asking yourself, am I analyzing a business or am I just betting the price will go up? Can save you from financial disaster to MR. Market. The allegory of Mr. Market is the perfect mental model for dealing with 24/7 news cycles and the constant emotional manipulation of financial media. It teaches you to treat the market's daily chatter as noise, not signal, and to see volatility as your servant, not your master. Margin of safety. This is the ultimate protection against the hype bubbles that form so easily in our interconnected world. Whether it's the dot-com bubble of 2000 or the speculative tech/crypto bubble of 2021, a strict insistence on a margin of safety would have kept you out of the most dangerous assets at the worst possible times. It forces you to be a disciplined contrarian, which is the only way to generate superior returns over the long run. Graham would conclude that while the market's clothing has changed from ticker tapes to Twitter feeds, its body of human psychology remains the same. The tools for self-destruction are more powerful and accessible than ever, which makes the intellectual and emotional discipline he taught not just relevant, but critical for survival. He would urge us to use modern technology to apply his principles more efficiently, not to abandon them in favor of a faster, more dangerous game. Closing reflection. 10 timeless lessons for the intelligent investor. As we conclude our deep look into Benjamin Graham's masterpiece, we are left with philosophy that is as powerful and practical today as it was over 70 years ago. It's not a set of hot tips, but a framework for thinking that, if applied with discipline, can guide you to a lifetime of investment success. Let's break down this profound wisdom into 10 timeless lessons. An investor is a business analyst, not a market forecaster. Your primary job is to value a business. The market's job is to provide you with foolish prices from time to time. Never confuse the two roles. Know the difference between investing and speculating. Be brutally honest with yourself. If you are not performing thorough analysis to ensure the safety of your principal and an adequate return, you are speculating. Keep speculation separate and strictly limited. Use Mr. Market. View market volatility as your greatest ally. Let Mr. Market's manic depressive mood serve you. Buy from him when he is pessimistic and sell to him when he is euphoric. Never let his anxiety become your own. Insist on a margin of safety. This is the central concept of investing. Never overpay for an asset, no matter how wonderful its prospects seem. The gap between the price you pay and the value you get is the ultimate source of your returns and your protection against error. Focus on risk first. The intelligent investor's first priority is not maximizing gains, but minimizing the chance of irreversible loss. By focusing on not losing, the gains will eventually take care of themselves. This is a path to sleeping well at night. The price you pay determines your return. A wonderful company can be a terrible investment if bought at too high a price. A mediocre company can be a wonderful investment if bought at a bargain price. The asset itself is only half the equation. The price is the other half. Humility is your greatest asset. Acknowledge that you cannot predict the future. This humility will lead you to diversify, to demand a margin of safety, and to avoid the speculative manias that periodically grip the market. Overconfidence is the investor's worst enemy. Discipline is more important than IQ. Investment success is not about being the smartest person in the room. It is about having a sound intellectual framework and the emotional discipline to stick with it through thick and thin. Think for yourself. Do not outsource your thinking to the crowd, the media, or the experts. The market is most dangerous when everyone agrees. A contrarian temperament is essential for buying low and selling high. Be patient. Investing is a marathon, not a sprint. The rewards go not to the most active, but to the most patient. Let the miracle of compound interest work for you over decades, not days. Applying the lessons right now. So, how can you, the average investor, apply these lessons right now? Start by building a portfolio policy based on Graham's defensive principles. For most people, this means creating a simple, balanced portfolio of low-cost, globally diversified stock and bond index funds. Decide on your target allocation, perhaps 60% stocks, 40% bonds, and rebalance it once a year. This simple, automated strategy embodies the principles of diversification, discipline, and long-term thinking. It protects you from the folly of stock picking and the temptation of market timing. Then, commit to a regular savings plan. Automate your contributions every month, regardless of what the market is doing. This is called dollar-cost averaging, and it's a practical way to live out the wisdom of buying consistently, without letting Mr. Market's mood scare you. Finally, dedicate yourself to lifelong learning. Read books, study business, and learn to read financial statements. Even if you only ever own index funds, understanding the principles of business value will give you conviction to stay the course when times get tough. Graham's path is not the most exciting. It won't give you thrilling stories to tell at a party, but it is the most reliable path to financial independence. It is a philosophy of prudence, patience, and profound common sense. It teaches you that the ultimate goal is not to be richer than your neighbor, but to have the financial security to live life on your own terms. That is a true return of the intelligent investor. And there you have it. The enduring wisdom of Benjamin Graham's The Intelligent Investor. It's not just a book about stocks and bonds. It's a book about mastering your own emotions and building a life of financial security through discipline and reason. It's a timeless compass that can guide you through any market storm. We hope this deep dive summary has given you a solid foundation and inspired you to think more like a business owner and less like a speculator. The principles we discussed today are the bedrock of true, lasting wealth. If you found value in this breakdown of The Intelligent Investor, make sure to subscribe to Capitura and click that notification bell. We're on a mission to bring you the world's most powerful financial wisdom, chapter by chapter. And you won't want to miss what's next, because we're covering another classic that can completely change how you think about money and markets. Thank you for investing your time with us. Now go and be an intelligent investor.